All right, let's talk about gold and silver. So many investors just lump them together, right? But believe me, treating them the same is a huge mistake. They might both be shiny, but when it comes to your money, they play by completely different rules. So, why does this matter so much? Honestly, because getting this wrong, not understanding the real difference, could literally cost you thousands. It's one of the biggest blind spots for investors. So, let's break it down. The secret is something we're calling the hidden power gap. Think of it like a secret code buried deep in their financial DNA. And this code, it dictates everything about how they act, especially when things get crazy in the markets. And today, we're going to crack that code together. Okay, so let's get right into it. What is this power gap? See, the biggest mistake people make is they just look at the price per ounce. That's not the story, not at all. The real difference, it's all about their purpose. So this gap, it's this fundamental divide in what gold and silver do in the world. Gold is pretty straightforward. It's almost purely a financial asset. But silver is living a double life. And that double life creates totally different behaviors, unique risks, and, you guessed it, some incredible opportunities. Now, if you only remember one thing from this slide, make it this slide. Gold is what we call the ultimate fear asset. When the markets are in a panic, when everything feels uncertain, where do people run? They run to gold for safety. Simple. But silver is a fear plus a factory asset. Yes, it's a safe haven too, but a huge chunk of its value is tied directly to factories, to industry, to economic growth. And hey, don't just take my word for it. Look at the numbers. A massive 55%. That's over half of all silver demand comes from industrial use. We're talking about everything from your phone to solar panels and electric cars. It's literally built into the modern world. Investment, that's actually a much smaller slice of the pie. Okay, now let's talk size. The gold market is a giant, an absolute behemoth at around $14 trillion. Silver, it's just a fraction of that. Now, why should you care? Because a smaller market means it takes way less money to make big waves. A little ripple of investment in the gold ocean is barely noticeable. That same ripple in the silver pond, it can be a tidal wave. That's where volatility comes from. All right, so we've got the theory down. Now let's see how this power gap actually plays out in the real world, with real money. Because this isn't just some academic exercise. This has direct consequences for your portfolio. We're talking about a world of extreme risk, but also extreme reward. You know, there's a saying on Wall Street I love. They call silver gold's levered cousin. And it's perfect. Think of it like this. When gold takes a step, silver takes a leap. It moves in the same direction, but everything is amplified. It's just way more dramatic. Want a perfect example? Just look back at the 2020 pandemic recovery. Gold did great, right? A solid 25% gain. Fantastic. But silver, fueled by that fear and factory demand, it went ballistic. It shot up almost 48%. That is nearly double what gold did. That is the power gap in action, right there. But, and you have to hear this, that leverage is a total double-edged sword. That same volatility that gives you those jaw-dropping gains, it works on the way down, too. When the market turns south, silver can, and often does, fall much faster and much harder than gold. So, how can we actually keep an eye on this relationship? Well, there's a fantastic tool called the gold to silver ratio. It's super simple. It's just the number of silver ounces you'd need to buy 1 single ounce of gold. And lately, that number has been hovering around 64 to 1. And you gotta understand, this ratio is not a fixed thing. It's constantly moving, it's a dance. I mean, just look at this year. Back in April, the ratio blew out to 104 to 1. That was a massive signal that silver was looking incredibly cheap compared to gold. Fast forward to the end of the year and boom, it snapped all the way back to 64 to 1 as silver rallied hard. Watching this dance is absolutely key to a smart strategy. Okay, so now you get the gap. You see the difference. The big question is, what do you do with this information? How do you actually use it? Well, let's get into the toolkit. Let's turn this knowledge into a real, actionable strategy. Here's a simple but really powerful rule of thumb that a lot of pros use. It's called the 80-50 rule. The idea is, when that gold to silver ratio gets above 80 to 1, that's a potential signal that silver is undervalued. It might be time to pay attention. On the flip side, if the ratio drops below 50 to 1, the thinking is that silver might be getting a little pricey compared to gold. Think of this as your quick reference guide, your cheat sheet. Gold, its job is monetary, it's huge, it's stable, and it runs on fear. Silver, its job is hybrid, part industrial, part monetary. It's smaller, way more volatile, and it runs on that special mix of fear plus the factory. So what does this actually mean for your money? Well, it really depends on what you're trying to do. Are you conservative, focused on just preserving your wealth? Maybe a 70-30 split, heavy on gold, is your speed. Looking for a mix of growth and stability? A 60-40 balanced approach might be perfect. But if you're aggressive, if you're really chasing that high growth potential, then a strategic allocation to silver, well, that could be a serious power play. Wow, we have covered a ton of ground here, right? From the core differences to actual strategies. So let's boil it all down to the one final most important takeaway. Here it is. If you walk away with just one thought, let it be this. Gold is your financial insurance policy. It's for protection. Silver is your cyclical, volatile, industrial hybrid investment. It's built for growth. So there you have it. You now understand the hidden power gap. So the last question isn't for me. It's for you. Look at your own portfolio. Is it built for stability, to ride out the storm? Or is it built for growth, to catch the lightning in a bottle? The answer to that question, well, it changes everything.